In this video, we're going to look at one of the best ways to undertake a crypto arbitrage trade, and it's called a spot futures arbitrage. I'm going to be using Pionex to show you because they actually have a trading bot that does this, but we're going to go through what a arbitrage is in crypto, some of the pros and cons of this strategy, how it works, and then how to actually implement this strategy. I'm going to use Pionex as an example because they let you run the strategy and do all of the trades that you would need to do all in one go. So I'm going to show you that. I'll put all of the timestamps in the description below. So firstly, what actually is an arbitrage in crypto? The whole point of an arbitrage is you're not taking any market risk. If you're taking market risk, like going long or short or buying and hoping that the price goes up or down a certain way, you are taking a directional position. An arbitrage attempts to completely remove the profit and loss from prices going up or down. Hence, an arbitrage only works if there's no or very minimal market risk. You have to have a same or a similar financial asset, not all of the time, but if essentially with an arbitrage, you're trying to take extra profit out of the market from trading on two different venues or some other way that there is an income or a yield from doing something without any market risk. For example, trading price discrepancies across markets. So what we're going to look at, and this is what Pionex do, with their crypto trading bot as well, which is called the cash and carry trade. What is the cash and carry trade? It's actually very simple under the surface, but what you do with this strategy is you buy Bitcoin in the spot market. So that's a cash settled trade. So you use US dollar Tether or another stable coin, and you actually go ahead and buy BTC and you take a long position in the market. Now that's a directional trade, and if the price goes up, you make money, and if the price goes down, you lose money. So we have to do another trade in order to take that directional risk completely out of the picture. So what you do is you sell the exact same amount of Bitcoin in the futures market, right? So you cash settle Bitcoin, you have that in your account, and you actually are an owner of spot Bitcoin. But in order to net and hedge off your exposure, you sell the exact same amount in the futures market. The reason why you go over to the futures market is because you can't sell something that you already have or don't have, because then that's a directional trade again. So what we have here is one BTC long in the spot market and one BTC short in the futures market. That's a derivatives market where you can actually sell short, meaning that you can sell and not actually have to deliver any Bitcoin. It's a cash settled derivatives contract market. So your net position is one long, one short, hence your net position is zero, theoretically, for this cash and carry trade. Why do that then? Where's the arbitrage? The arbitrage comes from earning something called funding from traders. This happens through the futures market, and so I'll explain that now. So a funding rate is something specific to the futures market, and especially in crypto as well, and here's how it works. So what happens in the futures market is that one way of trade will pay this funding. Now, a funding is something that happens specifically with crypto futures as well. It's really important with crypto futures because what they do, because a lot of crypto futures are perpetual, as you can see here, meaning there's no expiry date, it's possible for the underlying futures contract and the spot price of Bitcoin, in this example, to get out of whack. Funding is a way for the platforms to get supply and demand in the right space so that the futures contract price for Bitcoin matches the underlying price. It obviously has to, because there can't be these arbitrages. You can't have the price of BTC at a crazy price compared to the spot. So there's a funding countdown you can see here. Now, a funding is a mixture of the funding rate and also borrowing rates that platforms charge. In any case, the funding is something that is paid from one side of the trade to the other side of the trade. Most of the time, longs in the futures market, they are people going long buying and betting on the price going up, will pay short sellers. That's really important for our arbitrage trade, which I'm going to go through right here. So not all of the time, but often longs will pay shorts. So if we are short in the futures market, that means we receive this funding. Now, it doesn't happen all of the time. If the market is in a downtrend for a very long period of time, short sellers may well pay long buyers. So that's not great if you're short in the market, because you have to pay that funding. However, we can actually see over time who pays this the most and what the yields are over time. If you come to any futures trading screen, I'm on Binance here, but this is funding countdown. You can see this is 0.01. Now, the funding on Binance happens every 8 hours, I believe. So you can work this out at 0.01 times 3, and that gives you a day rate of 0.03. And then you can times that by 365, and you're looking at something like 11% as a yield from this funding rate. Now, that's not all one way. Like I said, sometimes longs pay shorts and sometimes shorts pay longs. But this is the funding rate, and it's on all platforms with crypto where we get our yield in this arbitrage trade. So crypto futures are perpetual, and funding keeps the price in line with the spot, can be around 4 to 10% APY. It changes, and it also depends on who is paying the funding over time, every 8 hours, either long or shorts. But you can work this out very easily. So we're going to go back to Pionex and actually see what's happening right here. What Pionex will show you with this spot futures arbitrage bot is how much this strategy is taking out of the futures market over time. Now it changes per asset. I've got Bitcoin here, as you can see. So the 7-day APR, 3.68. If you had it in for the last 180 days, you've got 2.81. You can switch it over to other assets. We have ETH here, which pays much higher rates. You can see a little bit higher over time, right? So paying about 5 to 10% over time. Now you can actually leverage up. I'll show you exactly how to use this bot in a second, but let's see how we're getting this arbitrage. Remember, if we're in the spot market and the futures market, what we have to do is go long Bitcoin. Okay, so if you've got $50,000 long Bitcoin, you also have to short the exact same amount in the futures market. So you are net even. But because short sellers often receive the premium, which is the funding rate, that could be 5 to 10%, depending on how many fundings you receive and what those funding rates actually are over time. Before I show you exactly how to use this bot, which is really simple, I'm going to go over some pros and cons of this strategy in general. The first one is that the arbitrage is not entirely risk-free, especially if you're using leverage. There's some things to keep in mind, which I'll go through in a second. The second one, the most important thing here, is that this works best in bull markets or upwards markets. The reason being, we as short sellers in the futures market want longs to pay us. And that happens more often in bull markets, or at least, not really downwards trending markets. You can still make yield in bear markets, but it's going to be less than if longs are paying a ton of funding and the more fundings come from longs to shorts. So you can just see over time where the yield is over the long term. For example, on Pionex, I just show you exactly the 180-day APR is 2.81%. We're in a bear market right now, actually. So, this is a lot lower than usual. In a bull market, this goes up to 10, 12% easily because more longs are paying shorts, the funding's higher, and shorts are getting way more fundings. And so in a bear market, yields will come down a bit. In a bull market, you're going to get a lot more. Also, yields can potentially be negative. If we're in a bear market for 5 years and it's just down, 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 then of course shorts aren't going to get paid by longs that much. And so that is potentially a risk. However, over the long term, you can see we're in a 180-day APR is still in the positive, despite all of this time essentially being in a downtrend for Bitcoin. So yeah, works best in an uptrend, but also can work in a bear market as well. So you can do this arbitrage yourself if you can buy in the spot and sell in the futures at the exact same time onto platforms, which is almost impossible. So that's why trading bots are used. So I'm going to show you how to use this here just on Pionex. You can choose the asset. By the way, I'll leave a link to them in the description. They often give some deposit bonuses and offers as well, depending on when you're signing up. So you can check that out. I'll leave that in the description. But you can see on Pionex, you basically have Bitcoin and ETH to choose from. I would, trade these really because these are, just the most liquid investments. And so you're not going to get some crazy price movements in them. So I'm going to go back here. I'm going to look for BTC right here. And then literally you just pay in US dollar tether and then pay how much you want in for the investment. Now, what it's going to do behind the scenes, it's going to take your investment and buy as much Bitcoin as it can in the spot market. Then what it's going to do is net that off in the futures market. So it's going to work out, like if you put 2,000 in here, it's going to work out how much it can spend to put in the spot and the futures to hedge that out. So that's it. So you really should have a neutral market position. And the only difference now is this APY, which, you know, is better in bull markets and less in bear markets, just because of how that funding works. Now, another important thing on Pionex anyway is this advanced settings where you can use leverage. So you can use 1x leverage, which is nothing. You have 2x or 3x. So how are they using leverage here? Well, firstly, every time that you introduce leverage, you are introducing the risk of loss a little bit more, because leverage exacerbates volatility. Now, what are they actually leveraging here? Well, essentially what they're doing is taking more leverage in the short side of the trade, right? So on futures trading platforms, you can actually use leverage and put down less than the trade. So as an example, let's say we were going short $1,000 of Bitcoin in the futures market, and that means we would be buying $1,000 in the spot market to have that neutral trade. Well, if you were using 1x leverage in the futures market on Binance or something like that, I think Pionex actually do this on Binance, like the automatic trades, you would have to put $1,000 down if you were to go 1x leverage. And so you would need $2,000 to get this trade out. But if you can use leverage, for example, 3x leverage or 2x leverage, let's say 2x leverage, you only need to put $500 down for the short trade, but your position can be 1,000, right? Because 500 times 2x is 1,000. So you have $1,000 short position, but you've only put 500 down. And so you now have $500 that's free cash that can actually go back into here. So you can actually go long $1,500. So it's going to work out essentially, if you're doing 2x leverage, you put less money down on this side, and then it's going to work out how much free cash you have to put in the long position. So essentially by using leverage, you're just having a less down in the futures market, which enables you to put more in the spot. And that means you can have a larger spot in comparison to what you could have, and then you're just earning an APY on a larger principal amount. The downside of using leverage is that it introduces the potential that the short position will get stopped out. The reason why is because when you have a short position, what you're essentially doing is betting on the price going down. And if the price goes up, your short position is in a loss, even though you don't have any, kind of market risk, because your short position is gaining, right? And so there's no market risk because you're not gaining from the price going up or down, because they will net each other off. However, in the futures market, that specific part of the trade is going to be in a loss, even though your spot is in a gain. And so the futures trading screen is going to only allow you to have a certain amount of loss. And so the more leverage that you use, your liquidity or your liquidation price gets closer to your entry price. So when you're using leverage, what will happen is that the bot will actually do this by itself and essentially just manage the position, where if it's getting anywhere near your liquidation, it will basically sell you out of your position. So there is, in theory, no more risk here. The risk is, though, that if the price does go up a lot, then this will potentially exit all of the trade and not be earning those funding rates for you, because it doesn't want to get in a bad position with a loss on the futures trading screen and get stopped out because there's some fees there. So it's going to automatically, as you can see, price gap control, it's going to automatically sell you out of the position if the futures side of the trade gets in a mess. And so without leverage, you can afford for the price to go up a lot more for that futures trade, but it's going to sell you out automatically anyway. But yeah, something to keep an eye on is that if you're running this for a very long time, when the price rises, then it may kind of get you out of the trade at some certain point. That's by far the most popular arbitrage in crypto, going short in the futures market and then long in the spot market to net off your position, and then essentially try and get the arbitrage from the funding rate. It does work best in bull markets. You're going to be making more. And also, you probably do need a trading bot to do this, to kind of manage that position for you. That's why I use Pionex as well. If you want to check them out, I'll leave them linked in the description for you. They often give bonuses and sign-up offers and stuff. I'm James with MoneyZG. Cheers for watching, and I'll see you in the next one.